Welcome back to the deep dive. Today, we're really getting into it. We've got a stack of recent reports, investor presentation, press release, board outcomes,
Yep, the full set.
all from a major player in retail health insurance. We're looking at their Q2 and half-year results for fiscal 26.
Right. And it's a lot of data, you know.
Hmm.
You've got IFRS, IND, IGAP reporting standards mixed in there.
Exactly. So our mission today, for you listening, is pretty straightforward. We want to pull out the main story fast.
What's driving profit? How are they getting more efficient? And importantly, does any of this actually help the customer? That's what we need to figure out.
Okay, let's jump right in then. Top line number, what's the big headline for the first half, H1 FY26?
Profitability. That's the main story. Profit after tax, PAT, shot up 21% compared to last year.
21%, wow.
Yeah, landing at 518 crores under IFRS. But honestly, the number itself isn't the whole story. It's how they got there, the quality of that growth.
Quality, what do you mean by quality in this context?
I mean, it wasn't just like riding a rising tide. It was driven by real improvements in how they run the business. You see it clearly in their combined ratio, the COR.
The COR, okay.
When that improves, it means their core insurance operation is just healthier. That's the engine we need to, take a closer look at.
All right, let's look under the hood then. They did still have decent growth on the top line, right? That's kind of the starting point.
Oh, absolutely. Gross written premium, GWP, hit 8,809 crores for the half year. That's 12% growth year on year. Solid.
And the retail part, because that's their main focus, isn't it?
Exactly. And retail GWP grew even faster, 17%. Reached 8,332 crores. So yeah, they're growing, and they're growing where it counts most for them.
But back to efficiency, because that seems key to the profit jump. The combined ratio tightening, where did that come from? Was it just cutting costs?
Well, cost management was definitely part of it. You see, the expense ratio got better. It dropped from 31.1% down to 29.7% in H1.
Okay, that's a decent drop.
It is. The reports say it's down to better manpower productivity and just being disciplined about spending. Standard stuff, but effective.
But the other side of the COR is claims, right? What happened there?
Right. And this is interesting. The net incurred claims ratio actually decreased slightly by 30 basis points, settling at 70.6%.
Lower claims ratio. Good for profit, obviously. But the immediate question is why? Are they just, making it tougher to get claims paid? Or is something else going on?
That's always the worry, isn't it? But if they were just being difficult, you'd expect customer complaints to soar, satisfaction to drop.
And did they?
We'll get to the customer metrics later, but spoiler, they actually improved. So the sources suggest it's more about better underwriting. They use the term portfolio recalibration.
Okay, portfolio recalibration. Let's translate that for everyone listening. What does that mean in practice?
It basically means they're being more selective about the business they write, especially in the group segment.
Group health, like for companies.
Exactly. Those contracts often have really thin margins, sometimes even loss-making, and high claims rates. So if they strategically shed some of that less profitable group business,
Their overall claims ratio naturally improves because the remaining business, especially retail, is healthier.
precisely, they're focusing resources where they get better returns and, frankly, better risk profiles. It's active management of their risk pool.
Okay, that makes a lot more sense. So you combine that smarter underwriting or recalibration with the tighter expense control.
And bingo. Your combined ratio improved significantly. It went from 102.1% down to 100.3%.
Just kissing 100%. So premiums are basically covering claims and costs now.
Almost perfectly.
Yeah.
Which means the investment income they earn on the premiums can flow more directly to the bottom line, driving that 21% PAT growth.
Got it. And just quickly, solvency. Are they still well capitalized?
Oh yeah, rock solid. Solvency ratio was 2.15 times, way above the minimum required. So they're managing risk well while chasing this efficiency.
Okay, so the financial picture is clear. Efficiency gains, driving profit. But that profit has to start somewhere, selling policies. Let's shift to their market position and how they actually reach customers.
Right. And strategically, their focus hasn't wavered. Still the leader in the retail segment, holding on to a hefty 32% market share.
And that's built on keeping customers happy, it seems. You mentioned growth in fresh retail premiums was strong.
Very strong, up 24%. Maybe even more importantly, their renewal persistency, people sticking with them year after year, is incredibly high in retail health, 98%.
98%. That's amazing loyalty. Once they get a customer, they keep them.
It suggests the products are resonating. And they highlighted one specifically, the Superstar product.
Oh, yes, I saw that.
It crossed a 12,250 crore premium mark within its first year. That kind of rapid uptake tells you they hit a sweet spot in the market, either features or price or both.
Okay, products are working, customers are staying. How are they getting these products to the customers? The distribution channels. This is where I saw some interesting contrasts.
Yes, definitely some dynamics worth unpacking here. The traditional agency channel, individual agents, still the absolute giant.
Still dominant.
Oh, yeah. 82.7% of their gross written premium comes through agents. And they actually grew the agency force slightly up to over 805,000 agents. Stability and scale there.
Okay, so the bedrock is solid. But where's the excitement? Where's the growth coming from?
Digital, no
Yeah.
question. This is where it gets really interesting. Fresh GWP, so new business from their direct-to-consumer website and app, plus digital partnerships,
Yeah.
saw absolutely massive growth, plus 47% in the first half. Hit 390 crores.
47%, that's huge acceleration.
It really is. It shows where the momentum is building. The future growth engine looks very digital.
But then there's the other channel. Banca and alternate partnerships, what's happening there? Because the numbers looked, well, not good.
Not good at all. That's the puzzle piece, like you said. Fresh GWP from Banca selling through bank partners actually declined, down 14%.
Down. Even though they added partners. I think the number of banca partnerships went up to 77.
Exactly. More partners, less new business. It dropped to 265 crores in H1. That's a really significant disconnect.
So what's going on there? Any clues in the reports?
Not explicitly, but you have to wonder, right? Are the bank staff just not incentivized enough? Are they pushing other financial products instead? Or, and this is the intriguing possibility, is the digital channel just becoming so easy, so efficient that it's actually pulling customers away from the bank channel? Maybe people prefer the direct online route now.
Cannibalization, essentially.
Could be. Or maybe just a strong preference shift. It definitely raises big questions about where they should focus their distribution efforts and resources going forward. Investing in bank partnerships that aren't delivering seems, well, questionable when digital is booming.
Yeah, that 47% growth versus minus 13%, it's a stark contrast.
Yeah.
Okay, before we leave the financials and channels, there's an accounting change note, right? Something about GWP recognition.
Yes. Important clarification. Regulatory change. They had to adopt a new way of recognizing gross written premium for certain long-term policies, called the 1N basis.
1 over N. Okay, what does that mean, simply?
Think of it like this. If a policy lasts, say, 3 years, instead of booking all the premium revenue in year 1, you now have to spread it out 1/3 each year, like accounting for a subscription.
Got it. So it smooths out the revenue recognition over the policy life.
Exactly. And because of this change, which took effect October 1st, 2024, they had to adjust the reported GWP figure downwards for the half year, by quite a bit actually, over 77,000 lakhs.
So the reported GWP growth looks a bit lower than it might have otherwise, just because of this accounting rule change.
Precisely. But, and this is the crucial point they make, it had no material impact on the profit and loss. The underlying profitability and cash flow weren't affected, just the timing of how revenue is booked on paper.
Okay, important context. Let's pivot now to the customer experience side, because if they're getting more efficient, is it translating into better service? You hinted at this earlier.
Yes, and the numbers here are pretty compelling. They track Net Promoter Score, NPS. Overall, NPS ticked up from 59 to 61, which is good, solid improvement.
Okay, but the real test for insurance is claims, right?
Absolutely. And that's where the big jump happened. Claims NPS went from 52 all the way up to 61.
Wow, 52 to 61. That's a massive improvement in how people feel about the claims process.
Huge turnaround. It suggests that efficiency drive isn't coming at the expense of the customer during that critical moment.
And does that tie into fewer complaints?
It does. Grievances per 10,000 policies actually decreased, went down from 22 to 18. So smoother operations seem to mean happier customers and fewer problems.
What's driving that improvement operationally? Speed, technology?
Both, it seems. They have this ambitious internal goal. Cashless claims processing in under 3 hours.
To 3 hours, that's fast.
Very fast. And technology is clearly the enabler. They mentioned their AI-enabled claims platform. Get this, 75% of their claims are now auto-adjudicated.
75%.
Yeah.
Handled by AI without human touch.
Largely, yes. Think about what that means for speed, consistency, and cost. That directly connects back to the improved expense ratio we talked about earlier.
Right. The tech investment is paying off directly on the P&L and improving the claims NPS. That's the ideal scenario.
Exactly. And customers seem to be engaging more digitally overall. Their customer app downloads passed 12 million.
It's not just about claims either, is it? I saw some big jumps in wellness usage.
Oh, yeah, huge focus there. Telemedicine consultations booked through their platform up 121% year on year.
Wow.
And preventive health checkups also saw massive growth, up 88%, over 250,000 checkups in the half year.
That's smart too. Investing in prevention should, theoretically, reduce big claims later on. Supports that claims ratio again.
It's all interconnected. It's a long-term play on improving the overall health of their customer base and, by extension, their own loss ratios.
One more operational point, the hospital network.
Right. They highlighted that 78% of all their cashless claims are handled through their agreed network hospitals, the ANH network.
What does that tell us?
It suggests a well-managed network where they likely have pre-negotiated rates and standardized processes. This helps control claim costs and ensure consistent service levels, feeding back into both efficiency and potentially customer satisfaction.
Okay, so strong operational performance, tech paying off, customer metrics improving. We need to add some external context, though.
Yep.
Any market factors helping them?
Yes, the MD and CEO actually called it out. He mentioned strong tailwinds after the GST exemption on retail health insurance premiums kicked in.
Ah, the tax change.
Yeah, he said they saw a definite uptick in demand, especially noticeable in the October trends, which is just after this reporting period ended. So government policy gave them a bit of a boost too.
Context also means that looking at challenges. There was a cybersecurity incident, wasn't there?
There was, yes. Back in August 2024, the reports confirm unauthorized access to some data.
And that had consequences.
It did. Regulatory consequences. IRDAI, the insurance regulator, issued a show cause notice in February 2025 because they weren't fully compliant with cybersecurity guidelines.
Ouch. Did that result in a fine?
Yes, ultimately a penalty of 339 lakhs, about 3.4 crores.
Okay. And have they dealt with that?
Seems so. They accounted for the penalty in their Q2 FY25 results and actually paid it in September 2025. So it's financially settled, but obviously highlights the ongoing importance and cost of robust cybersecurity.
Definitely a critical area. Anything else on the governance or ESG front?
Just a couple of notes. They mentioned being ranked hashtag 48 globally in the S&P Corporate Sustainability Assessment for FY24, which is quite respectable.
Okay.
And they highlighted workforce diversity stats, 29% women in the overall workforce, and 22% representation on the board. Standard disclosures, but shows it's on their radar.
All right, let's try and wrap this all up. If you had to summarize the core story of these H1 FY26 results for the listener.
I'd say it's a story of focused execution. The 21% profit growth wasn't accidental. It came from, 1, tight control over expenses, 2, smart underwriting, especially trimming less profitable group business, which improved the claims ratio, and 3, really doubling down on digital capabilities.
Right. And all that reinforces their dominant position in that key retail health market.
Exactly. So what this really demonstrates for you, the listener, is how those operational levers, things like improving the expense ratio, using AI for claims adjudication, aren't just internal metrics.
They directly translate into that bottom line profit growth.
Correct. And crucially, in this case, it seems they managed it while also improving customer satisfaction, particularly around claims, and keeping their solvency super strong at 2.15x. It's a picture of profitable, well-managed scaling.
Okay. A strong performance overall, driven by efficiency and digital. But let's leave our listeners with something to hit them on. Here's our final provocative thought for today.
Let's hear it.
The sources paint a really stark picture of distribution channels. You have the massive, stable agency network. You have digital exploding upwards, 47% fresh premium growth. And then you have Banca, the bank channel, actively shrinking down 14% despite having more partners.
Yeah, that disconnect is striking.
So the question is, as we race towards this national goal of insurance for all by 2047, what does this divergence mean? Will the speed and efficiency of digital channels eventually just take over? Will they cannibalize the slower traditional agency and banking networks? Or can they all coexist, just serving different needs?
That tension between digital speed and traditional scale. Yeah, that's definitely something to watch. Where will the growth truly come from in the long run?
Something to mull over. We'll be back soon with another deep dive.